my name is Nurintan Zafira.
Hi, I am Shazana Anissa.
Hi, my name is Ida Rahayu binti Ramli.
Hi, my name is Siti Nadira.
Hello, hi. My name is Muhammad Aidil Arif.
So, I will begin our presentation by briefly explaining about the company background. The company that we have chosen is 7-Eleven Malaysia Holdings Berhad. It is one of the famous 24 hours convenience store that have almost 2,400 outlets nationwide, and it was incorporated in Malaysia since 1984. The mission of this company is to consistently serve the changing needs of their customer for convenience. And the vision of this company is to be the best retailer of convenience. Despite selling other people's products, 7-Eleven also have their own products such as Sloopy, Enda Mineral Water, 7-Eleven Bakery, fresh fruits and also hot beverages.
Next, I will explain about industry analysis. Type of industry for 7-Eleven is retail, which is convenience store. It operates 24 hours daily and small in size, and carries a limited stock of foods, drinks, and other high turnover products. Other products available includes coffee, fresh meat, daily sandwich, financial service, and delivery service. Let's explain about SWOT analysis. And the first one is strength, and the first one is convenient location. With so many outlets throughout the world, it gives 7-Eleven significant location and convenient advantage. It is because 7-Eleven is located to nearby consumer residents. And the second point is overall brand equity. The brand equity translates into customer loyalty and reduced price sensitivity. And the third point for strength is product offering. 7-Eleven has several branded product offering, and the most famous one is probably Sloopy and Big Gulp. And the last point for strength is diversity of income. This is because the overall chain of 7-Eleven operates in multiple countries, and the parent company has essentially diversified its income. Okay, next, I will explain about weakness. The first point is high rental cost. Due to the need to locate the 7-Eleven outlets in very convenient location, they are likely to incur higher rental costs as a result. And the next point is high staff cost. This is because the store operates on 24 hours, and this of course require higher costs. And the last point for weakness is franchise. A management team is required to recruit, train, and monitor the various franchise. It will add to the overall cost structure.
Next, I will explain opportunities of 7-Eleven. For the first point is continued market development. 7-Eleven has opportunity on increasing the number of stores they have in existing market and cities, and increasing the number of countries that they operate in. And the next point is increased product offering. As we know, 7-Eleven has opportunity on being able to offer a greater selection of both physical product and services, such as ATM, cell phone card, and perhaps even car insurance. Other than that, co-branding location. 7-Eleven could expand their geographic coverage through co-branded outlet with other significant retail offerings, which gives advantage to 7-Elevens on attracting more consumers to buy in their store.
There are three trades, which is the first one is supermarket moving to 24 hours. In some parts of the world, one of high cost in supermarket is 7-Eleven. This is because this company have electricity in 24 hours, so they have a high cost in their operating system. The second one is supermarket moving to online deliveries. Many of the company have this type of service, which is they can send you the goods or groceries into online address or online deliveries. So one of the threat of this is they have not involved in online delivery service. And the third one is security. Because 7-Eleven is a convenience store, it have open in 24 hours. So they handle cash in their 24 hours basis.
Next, let's get a look for the common size on financial performance and financial position of 7-Eleven in year 2015 until 2020. Alright, as we can look from the common size for financial performance of 7-Eleven, it shows that after 2015, 7-Eleven had a drastic drop of net profit for the financial year until 2020, which is, we can see here, 2.78% in 2015 dropped to 2.29% in 2020. Although, for the total liabilities in the financial position of 7-Eleven also shows that there is an increasing percent where from 2015, they had 77.11% of total liabilities and it rose up to almost 15.71% that resulted in almost 92.82% of total liabilities in 2020. This shows that 7-Eleven had a problem in managing their liabilities and debt, which will lead them to get a lower profit.
Next is financial ratio analysis. It has 4 types, which is liquidity, leverage, profitability, and efficiency ratio. The first ratio is liquidity ratio, which means the ability to meet maturing obligation. As you can see, the graph shows that 7-Eleven has a problem to meet its short-term obligation, as it is reduced in current ratio and quick ratio from 2015 to 2016 and 2018 to 2019. The amount in net working capital shows negative value, which indicates that the current liability is more than current asset, which determine that the company are unable to cover their current liability with current asset. The trade payable is the highest contribution in current liabilities each year. Thus, 7-Eleven should improve in managing trade payable to be able to meet short-term financial obligation. Move to the next ratio, which is leverage ratio. Leverage ratio is the ratio that evaluates the ability of the company to service its debts and degree of financial risk. From the analysis, 7-Eleven shows that in 2016, it is the highest debt ratio and debt to equity ratio. This is because the company has increased their borrowing in non-current liability and decreased treasury shares in equity drastically in 2016. It indicates that the company used more debt than equity, as total liability is more than total equity. Then, debt to equity ratio decreased from 2016 to 2018 because the company used more equity than debt, as total equity is more than total liabilities. The decrease in time interest earned shows that the company has less ability to pay debt due to increasing in interest expenses year by year. Thus, 7-Eleven should decrease their borrowing and interest expenses in order to achieve a lower debt ratio and debt to equity ratio and high time interest earned. Next, profitability and overall operating results are known as profitability ratio. The graph shows that 7-Eleven has volatility on a profitable ratio with a little difference except for return on equity. With a little difference on return on asset, operating profit margin, net profit margin, and gross profit margin, it shows that the company has an ability to manage and generate earnings relative to its revenue, operating costs, and balance sheet assets over the time. Return on equity has the highest percentage in 2017. This is because the average total equity is lower than the previous year. From the 2017 to 2019, return on equity decreased due to 7-Eleven increase in equity through internal funds to support company growth. And last but not least, efficiency ratio. It is defined as effectiveness in managing assets and efficiency in handling operations. In the graph, it shows that 7-Eleven is efficient in managing their assets to generate sales as it is increased in account receivable turnover from 2015 to 2016. In 2017, it shows that the inventory turnover is decreasing by 3.3 compared to the previous year. This is because the COGS is increasing and resulting in reducing the ability to make more sales. Fixed asset turnover is decreasing year by year, except for in 2018, this increased by 0.06. Thus, the company should increase their fixed asset in order to support increase in sales. Average collecting period is decreased from 2017 to 2019, which indicates that 7-Eleven managed well in the time it takes to receive money from customers who purchase goods and services on their company.
For the judgment, the first one is credit risk. As we can see, 7-Eleven is company that have a high credit risk since it based on their financial SWOT analysis. The second one, market share of 7-Eleven, they do not have a highest diversity of business line. This means they do not have higher market share in the sector. A business strategy or investment memorandum competition segment will be begin by reviewing their details about the company, so they don't have a market share, a big market share. So the third one is high in liability. As we can see from the debt or leverage ratio, they have a lot in their debt and liability. For example, 7-Eleven increased its non-current obligation borrowing and significant reduced its equity treasury shares in 2016. The fourth one is 7-Eleven fastest growing competitors. From the overall overview, we can see that have a lot of company that same into this business sector. So they have a company can expand, but they have a fight to high competition to the others company.
The last but not least is the improvement that I will suggest to 7-Eleven. As a finance student, there is some strategy that I would like to suggest to 7-Eleven. The first one is the product development. For instance, 7-Eleven can come up with an idea, produce a very interesting product such as Sloopy ice cream or Sloopy cake. This can increase their sales and encourage people to buy more since people love Sloopy so much. Next is market penetration. Market penetration strategy is important to boost sales and make more profit. For instance, 7-Eleven can make their product available through currently famous is Food Panda such as Panda Mart, GrabFood and other e-commerce online platforms. Last but not least, 7-Eleven must keep up with the technology. Right now, we have a cashless payment system. So, 7-Eleven must provide their customer this payment method like QR Pay or e-wallet. Thank you.